Have you ever sold a covered call and then the market went up, but you didn't want to lose your shares, but you wanted to lock in that profit? In this video, I'm going to talk through the process I go through when I close a covered call, whether to lock in some profit or to avoid losing my shares. Before we dive in here, let me hear from you. Down in the comment section below, let me know if you're brand new to selling covered calls or if you've been doing it for a long time. If you've been selling covered calls for a long time, what are some of the favorite stocks you'd like to do covered calls in? Please let me know down in the comment section below. First, and very briefly, what is a covered call? When you sell a covered call, you're simply giving someone the right to buy or to call your stock away from you at a certain price within a certain time frame. The covered call position I'm going to share with you that I was in for several years is in TSN, otherwise known as Tyson Foods. Let's say, for example, you own 100 shares of Tyson and you want to turn it into a covered call. Well, if you were okay with the stock potentially being called away from you at $50 per share, you might sell the $50 covered call. You pocket that covered call option premium, then you wait and see what happens with the stock. But this video isn't about necessarily waiting and seeing. It's about doing something about it so you can lock in profits or avoid the stock from being called away from you. If you sold a covered call and at expiration the stock is trading above your covered call strike price, then the shares will be called away from you and you'll sell them at the price of that covered call. However, at expiration, if the stock is trading under or less than the covered call strike price you sold, then you get to keep that option premium and you still own your shares. So this video picks up with you already own some shares, you've already sold a covered call, and you don't want those shares called away from you. Or in other situations, you want to lock in that profit. Let me show you how I did it multiple times over a 2-year period in Tyson Foods. Here you see a spreadsheet where I tracked all my trades in Tyson Chicken over about a 5-year time frame. We're going to focus in here on the covered call section of this spreadsheet. I've highlighted my covered call trades with this light yellow beige color. I've been told I'm colorblind, so correct me if I'm wrong. That's the covered call trade. Notice that overall I was assigned about 600 shares of Tyson in early June of 23. Now, just so you know, before that I had sold a bunch of put options against Tyson Chicken. In fact, if I scroll up here, notice that we had collected about $7,000 by selling put options in Tyson Chicken over the previous several years. But then Tyson Chicken plummeted in price, as I'll show you in just a minute, and we bought 600 shares of Tyson at $57.50 per share. At that point, I began to collect the dividends, and I also started selling covered calls against my shares. At this yellow arrow on June 1st, that was the day I sold my first covered calls in Tyson. Now remember, we bought the stock way up here at $57.50 per share. On the day I entered the covered call, because the shares were assigned to me, it was trading for just over $50 per share. So it's trading for about 12% lower than where I had bought the shares at. As a result, I wasn't going to get very much premium for this $57.50 covered calls, even if I went out in time. I decided to sell the $50 covered call option. That put nice premium in my pocket, but it did leave me open to the possibility that if Tyson went up in price pretty far, I could be stuck selling my shares at $50 per share if I didn't do anything about it. I knew there was a possibility that Tyson might rebound, because usually a quick move down is usually followed by some move up. And that's exactly what happened. It had moved up some, but appeared to be stalling. And that's one reason why I decided to sell it right at the money. That ended up being a good decision because, as you see here, Tyson traded sideways for several months. If we go back to my spreadsheet, you'll see that we actually sold that $50 strike price twice. We sold it when we were assigned the shares in June, and then we sold it again on June 16th. In all, we got nice premium, over $2 per share for those covered calls. But then fast forward to July 17th, and I noticed that Tyson Chicken had made a new higher high and a higher low here. As a result, I wanted to roll that covered call strike price up because I didn't want the shares called away from me. Remember, I was assigned these shares way up here at $57.50 per share. And I was selling these lower strike price covered calls to collect as much premium as I possibly could. So I wanted to have my cake and I wanted to eat it too. I wanted to collect as much premium as I could, but I didn't want the stock called away from me. Because of that decision, as you see here, on July 17th, I sold the $52.50 covered call. For that, I got nice premium. I got $2.70 per share. Over the next several months, as you see here, Tyson just kind of traded sideways. It was kind of range bound with a low of around $50 and a high of around $57 per share. However, fast forward to October 6th, when we rolled this covered call, I noticed that Tyson had broke that support it had been finding around $50 per share. On the day I rolled this covered call, it traded as low as $46.51 per share. Because I had broken through that support, I didn't really want to sell that higher strike price covered call at $52.50 per share because I wouldn't get much for it. And with this renewed weakness, I feel like I'd be safe to sell a lower strike price covered call. As you see here, I was pretty aggressive about my placement. So I believe with this renewed weakness that Tyson probably wasn't going up anytime soon. So October 6th, I sold the $45 covered calls and again got nice premium. I got $3.68 per share. And by the way, during that previous covered call expiration cycle, I pocketed the dividend of 48 cents per share. That's one reason why I like selling covered calls and dividend stocks, because you kind of get that easy money, that easy dividend once a quarter. Over the next couple of months, as you see here, Tyson just kind of traded sideways. Actually found support right at our $47.50 cover call strike price several times. Now fast forward to the day I rolled this cover call. This is an important point. It's a pivotal point here because Tyson was about to do something it hadn't done in months. So I had to make the right decision here. Here's what I saw, and here's my thinking when I rolled this cover call. Notice over the previous about month and a half to 2 months that Tyson had been finding really strong, firm support in that $47.50 area. That was right at my $47.50 cover call strike price. Because of that strong support, and I believe that Tyson was now fundamentally undervalued, I decided to roll my cover call strike price up in case Tyson began to go up in price. So on November 14th, I decided to sell the January of the next year $47.50 cover call. And we still got pretty decent premium of $1.53 per share. Well, what happened? Here you see the chart of Tyson up until the next date that I rolled my cover call. Tyson did exactly what I thought it would do. It went up in price. It just went up more than I thought. Notice that in just a month and a half, it went up right at 17%. I mean, this is a chicken company. I had suspected that it would go up. I didn't think it'd go up by 17%. So now it's decision time. I had collected a ton of premium against this position. However, I bought the stock at $57.50 per share, and my cover call was $10 below that at $47.50 per share. But the stock was trading for right at $54.47 per share, so this position was in trouble. And if I knew something about it, the shares would be caught away from me at a lot lower price than I wanted them to be. Here's what the chart looked like on January 5th when I rolled this cover call. Remember, we had sold the $47.50 cover call that was now pretty far in the money. And I wanted to get that cover call strike price up as much as possible, but I didn't want to go way out in time. So here you see the trade I did. On January 5th, I bought those January 19th $47.50 cover call options back to close them out. That'll prevent the shares from being called away or assigned at $47.50 per share. I then went pretty far out in time, but I was able to sell the June 21st $50 cover call options. To help fund rolling that cover call up, I also sold some cash secured put options. That's one reason why I like keeping position sizing available to help prepare positions. By doing that, it lets me be aggressive on selling cover calls at lower strike prices because I can use selling additional cash secured put options to help fund rolling those cover call strike prices back up when I need that help. So I did go out 5 months, but I was able to get my strike price up by about 5%. And the icing on the cake is that I was still collecting those nice 48-cent per share dividends this whole time. All right, so here's where we're at. It's January 5th, and Tyson's trading for around $54.47 per share. And we're short the $50 strike price cover call option. I would prefer that call option to be higher, but I was okay with it. It's better than being short the $45 strike price cover call option with the stock trading that high. Over the next several months, Tyson did exactly what I wanted to do. It just kind of drifted sideways. I was hoping they would drift sideways for that entire period, then I could roll that $50 strike price cover call option up to 55 or even 57.5. But it didn't really want to cooperate exactly, because as you see here, towards the end of this option expiration cycle, it began to drift higher. It was making nice new higher highs and higher lows. This far right candlestick is the next day I rolled my cover call. Now remember, I'm trying to lock in profits on my cover calls, but even more importantly, I'm trying to prevent the shares from being called away from me at a strike price I didn't want to sell them at. So here's where we're at. On May 7th, the day I rolled this cover call option, Tyson was trading for right around $58.70 per share. On that date, I was short the $50 cover call option. So that option was over 10% in the money. Again, I wanted to get my cover call strike price up so I could benefit from stock price appreciation and prevent my shares from being caught away from me. Because of its recent strength, on May 7th, I rolled the June 21 $50 cover call options out to October, and more importantly, up to that $52.50 strike price. Again, I needed a little bit of help from my cash put option friends, but I was able to do this roll trade for a nice credit. One nice thing about where the stock was trading at was actually trading above the strike price where I was assigned the shares at. So I hoped I could get my cover call strike price up high enough and then let it be caught away from me. And overall, I'd have a really nice profit in this position. But things don't always go according to plan. As I fast forward the chart here, notice that Tyson went back up, retested resistance at 61.5, and then it began to decline and went all the way down to right at my cover call strike price, which if it was there at expiration, that would have been perfect because I could have rolled the strike price up again if it's still bullish. But then Tyson began to take off, began to make new higher highs and higher lows, and notice what happened here. It pushed through that resistance it had found multiple times over the previous year, then just absolutely took off in price, reaching a high of around $65 per share. The problem was that I was still in the $52.50 cover call. So that option was $12.50 in the money. But then Tyson did me a little favor. It came back down in price. On October 17th, with Tyson trading for right around $60 per share, I bought back that $52.50 cover cover call option. That option was about $7.50 in the money. And I wanted to get up as much as I could without having to go way out in time. So on October 17th, I bought back the options that expired the next day, October 18th, $52.50 cover call. And I had to go out to January, just a couple months, but I was able to get that strike price up by $2.50 per share. During these trades, I was always keeping an eye on my extrinsic value. You see, once your extrinsic value is next to nothing, your odds of the cover call being assigned go way up, especially if the stock is about to go ex-dividend. With Tyson being a dividend-paying stock and it pays a pretty good dividend, I was really watching my extrinsic value, especially right before the ex-dividend date. If I saw that there was less extrinsic value than the amount of the dividend, then I would roll that cover call option to avoid it being called away from it. So October 17th, we rolled that cover call option out several months and up to this $55 strike price. We were getting really close to that $57.50 cover call strike price that we had bought the shares at, but we weren't quite there yet. During that cycle, as you see here, at first Tyson cooperated perfectly, but then it took off and went way up in price to $65 per share again. But then it began to drift lower. On the day we rolled this trade, it was back down to right at the strike price we wanted to sell our new cover call at and hopefully exit the stock at. As a result, on December 23rd, we were able to roll our cover call strike price up to our original entry spot at $57.50 and just roll it out several months. So we bought the January 17th $55 cover call options to close out that position, and we sold the April 17th $57.50 cover calls. As you see here, the note I share with my patrons, this is the price we're ultimately hoping to exit this cover call position at. Fast forward to April 17th, with Tyson trading for around $60 to $61 per share, I decided it was time to let the position be called away from me. So we allowed it to be called away from us at $57.50 per share. As you see, knowing when is the right time to close out your cover calls helps you not only lock in profits, but also strategically plan adjusting your cover call strike price. By having a plan in place on how you're going to manage your cover calls, it allows you to make wise business decisions, especially on important events like ex-dividend dates and earnings announcements. This was a position that went against us, and then it went our way, then it went against us, it went back and forth multiple times over the several years we were trading in it. But in the end, notice how much cash we received in this one position. We pocketed over $14,888. Not bad for a boring chicken company. Strategically buying to close or buying and adjusting your cash secured and cover call positions is a vital technique you must know to be a long-term option trader. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. Ed, a YouTube viewer, asked a really nice question I thought some of you are probably asking as well. How do you find stocks to trade cover calls against? If you'd like to see how I find the stocks that I trade my cover calls against, check out the video at the link above and the description below entitled How to Find the Best Stocks for Cover Call Options. Until next time, happy investing, and we'll see you again soon.